And joining us now with more on the market's reaction to the Fed is Peter Cardillo, Chief Marketing Strategist of Rockwell Global Capital. Peter, thanks for joining us again.
Good to be back.
So the big takeaway, Fed Chairman Bernanke saying that there is no preset course. He's saying that tapering could start at towards the second half of this year, going into next year. He didn't really say anything different, did he?
No, exactly. In fact, he said nothing new. The Fed remains flexible as ever, and that's been the theme all along. And, you know, I think the only perhaps real change is the fact that they did indicate that perhaps they're going to use the 7% unemployment rate as a benchmark when they might begin to taper. So with unemployment...
But they have tapered, they have pegged the tapering to an unemployment rate in the past. That's
correct, but they always said 6.5%. Now they're talking about 7%, which might be a good indication that when the unemployment rate drops to 7%, if it drops to 7%, then they will begin tapering. So, you know, with unemployment at 7.6%, 6 percentage points to drop by now to the end of the year makes me somewhat reluctant.
Now, we got a lot of data on the economy from the Fed Beige Book as well. What did we take away from that?
Well, the Beige Book, you know, again, a slight improvement, but again, you know, hiring was highlighted and it remains spotty at best. And so that probably was the key to the Beige Book survey. And of course, consumer spending is doing pretty good, staying at a steady pace.
How significant is it that Bernanke noted that should the economy weaken, the Fed does stand ready to increase QE3?
Again, that's nothing new. He said that all along. And if that should happen, and there's a good possibility that we might see the economy actually slow from present economic growth. Look at the housing data today. We saw building permits down a little over 7%. That just simply means trouble ahead. And I'm not suggesting that we're going to see a major downturn in the housing market, but certainly the backup that we saw in mortgage rates have certainly taken a toll.
And it's funny you mentioned that, because one of the House representatives asked Bernanke that if a friend was asking for advice about refinancing his house, would Bernanke advise to do it now or later? And Bernanke joked back saying, well, he's not a financial advisor. But we are already seeing an impact on the housing market with new construction down 10% in June. Do you expect then that the market is already pricing all of this in?
To a certain degree it is. You know, the markets always seem to discount 6 to 8 months down the road. There is an element of that. But again, you know, I think it's a little too early to see exactly how much of a negative impact we're going to see from the speculative move that we had in the backup of yields.
Now, one of the issues here has been the market reaction. And the Fed is kind of making sure to temper down the volatility in the markets. Has he achieved that, or is it all null and void because the minute some action is taken, we can expect a big sell-off anyway?
No, in terms of, you know, yields going much higher from these levels, I think he has calmed the markets, and certainly the stock market is at record high, so there's no question about that. And you know what, I kind of think that the initial shock of him beginning to talk about trimming was just an excuse. The markets were high, and of course I'm not referring to the Treasury markets, but obviously the stock market was high. Right. It needed to pull back, and it did, and it just gave us more room to go higher.
And of course, many analysts are saying he's kind of leaving things relatively open for when he steps down in January and for the next Fed chairman to have some leeway there.
Absolutely, and it certainly looks as though his successor might be as progressive as he was.